welcome back to The Explainer. Today, we are diving into what was honestly a completely wild day in the financial markets. We're going to unpack the Q1 2026 earnings data from Fintech stacks, and it is absolutely fascinating. We get a front row seat to see how three totally distinct businesses are navigating our rapidly shifting economy. So get ready, because the numbers we're about to explore together tell a massive, massive story about the tech sector that we all rely on every single day. But to really grasp what's happening with these companies, we first need to anchor ourselves in the macroeconomic context of this specific day. The Dow literally just crossed 49,900. I mean, that's an all-time high. The Nasdaq closed up 2%. The backdrop here is, well, it's almost euphoric. Axios was out there reporting that the US and Iran are incredibly close to a peace deal, oil prices have dropped, and overall global risk appetite just massively spiked. And you guys, this is the exact, highly optimistic environment in which our three fintech companies decided to drop their earnings. Okay, let's dive into the agenda. First up, we've got the dominant breakout with Chime. Then, the grinding survivor with NerdWallet. Third is the strategic pivot with Ibotta. And finally, we'll wrap it all up with our final fintech scorecard. Starting right off with Section 1, the dominant breakout, Chime's Q1 profit. So, remember how ever since their IPO back in 2025, Chime was basically burning cash? Well, not anymore. They just delivered their very first quarter of GAAP profitability, and honestly, it was an absolute blowout. Total Q1 revenue hit $647 million, which is up 25% year over year. But you really have to look at their actual growth engine, platform-related revenue. That specific segment surged by 50%. This is entirely being driven by features like instant loans and their earned wage access product, MyPay. Get this, MyPay alone is generating over $400 million annualized, and they are doing it with a ridiculously tiny 1% loss rate. But what actually blew my mind is how Chime is pulling off these margins behind the scenes. It's a total Moneyball move. In the span of just 4 months, they scaled their AI-assisted coding output from 29% all the way up to 84%. The end result here? Their headcount stayed completely flat. They didn't hire an army of new devs, but their operational leverage just absolutely exploded. They are literally shipping faster without growing the team. Which leads us directly to this staggering number. Almost immediately after posting this profit, Chime's board authorized a $200 million share repurchase program. Now you know and I know. Announcing a buyback on literally day one of your first ever profitable quarter, that's not a financial necessity. That is an absolute corporate flex. It sends a very clear signal to the market. They view this profit as the launchpad, definitely not the ceiling. Okay, so Chime is thriving, right? But obviously not every company out there is experiencing this euphoric AI-fueled breakout. While Chime is using AI to practically print money, other companies are fighting against it just to hold their ground. And that brings us perfectly to our second archetype. Moving on to Section 2, the grinding survivor, NerdWallet's Q1. To really understand NerdWallet's current situation, you have to realize that they are trapped in what is essentially a brutal two-front war. On one side, you have these new AI search tools that are actively threatening the SEO traffic that literally built their entire business. And on the other side, the high-rate mortgage market simply refuses to cooperate. It's so tough right now that Morgan Stanley actually downgraded their stock. Yet, despite everyone expecting a massive, heavy revenue deceleration, NerdWallet fought tooth and nail. They managed to beat EPS estimates by exactly one single penny. To stay solvent, they've had to execute this incredibly gritty pivot away from everyday consumers and lean heavily into SMB financial services. I love how the source materials summarize their position perfectly with this quote. A 1-cent beat might not sound like a big deal, but when you're in a brutal 10-round heavyweight fight against high interest rates and massive AI disruption, just managing to stay mildly profitable, that is a huge success story for this specific kind of company. If mortgage rates eventually drop, NerdWallet is basically a coiled spring. But until that happens, survival is the victory. So we've seen explosive, dominant growth, and we've seen gritty, defensive survival. But what happens when a company decides its current identity just isn't enough anymore and attempts a massive strategic evolution right out in the open? That brings us to Section 3, the strategic pivot, Ibotta's evolution. Now, what's really interesting here is that on the surface, Ibotta actually had kind of a confusing quarter. They posted a slight 2.5% revenue dip, but you have to look at their quiet evolution. They started out as just a simple consumer coupon app, right? Then they evolved into a performance network. And now they are stepping into phase 3, becoming an underlying operating system. The The broader market looked at that tiny revenue dip and completely missed the fact that Ibotta is rewriting its very DNA, all while sitting on a massive 28% free cash flow margin. How are they doing this? By becoming distribution infrastructure. They are turning into the underlying rails that connect brands directly to consumers with promotions at the exact moment of purchase. And you can see it in the massive deals they're closing. They just secured an exclusive multi-year partnership with Uber, and they locked in Giant Eagle along with its 200-plus supermarkets. Make no mistake, these are not soft co-marketing deals. These are hard, locked-in infrastructure contracts. The source material uses a brilliant analogy here, saying, think of Ibotta the way you'd think of Visa in its early days. Nobody cared about the rails. They cared about the checkout. That just perfectly hits the nail on the head. It emphasizes how absolutely critical yet entirely invisible digital infrastructure can become once it is deeply embedded in a giant platform like Uber. I mean, Uber literally just became Ibotta's biggest pipe. And finally, Section 4, the Fintech Scorecard. Final results. All right, let's bring these three distinct narratives together and look at your final scorecard for the day. First, you have Chime, the breakout. They leveraged AI to print their first ever GAAP profit and confidently bought back $200 million in stock. Then there's NerdWallet, the survivor. They fought off brutal macro headwinds and AI threats to beat the street by a single, heavily defended penny. And then Ibotta, the pivot. They took a slight revenue hit on the chin, but effectively secured their future by signing Uber to become the invisible distribution infrastructure of the internet. It's just wild to think about. Three very different corporate psychology paths, all successfully manifesting on the exact same earnings day. Which really leaves us with the ultimate question. We are watching our economy being actively reshaped in real time by artificial intelligence, incredibly stubborn interest rates, and this massive race to own digital infrastructure. So, between the dominant breakout, the grinding survivor, and the strategic pivot, which of these three paths do you think represents the true future of fintech? It is going to be absolutely fascinating to watch how these exact strategies play out in the coming quarters. Thanks so much for joining me on this explainer, and we will see you next time. Keep learning.